Let's talk about something that sounds incredibly complex, but directly impacts every single one of us. From our grocery bills to our retirement savings. We're talking about America's latest credit downgrade and why it's triggering what many are calling a financial earthquake. Now, I get it. When you hear phrases like credit downgrade, rating agencies, or sovereign debt, your eyes probably start to glaze over. It sounds like a bunch of Wall Street jargon that has nothing to do with your daily life. It's boring, technical stuff, right? But I need you to stick with me here, because once you peel back the layers and understand what's really happening, the situation becomes much clearer and, frankly, a lot more concerning. This isn't just a headline. It's a tremor that signals a much larger seismic shift in the global financial landscape. First, let's break down what a credit rating actually is. Think of it as a financial report card. When you or I go to get a mortgage, a car loan, or even just a credit card, the lender pulls our credit score. That score tells them how reliable we are at paying back our debts. A high score means we're low risk, so we get better interest rates. A low score means we're high risk, and we'll pay more for the same loan if we can even get it. Countries operate on a similar, albeit much larger, scale. They don't have FICO scores, but they do have credit ratings issued by powerful agencies like Fitch, Moody's, and S&P. These agencies analyze a country's economic health, its political stability, and its ability and willingness to pay back its massive debts. The highest possible rating is AAA, the gold standard. It signifies absolute safety and reliability. A step down to AA+ is still considered excellent, but each notch lower signals a little more risk. And that increased risk comes with a higher cost of borrowing. Now, this matters immensely when the borrower in question is the United States government. The U.S. is the issuer of the most important financial asset in the world, U.S. Treasury bonds. These bonds are supposed to be the safest place on earth to park your money. The entire global financial system is built on this assumption. So, when an agency like Fitch downgrades the U.S. from that perfect AA rating to AA+, it's a big deal. It's like finding a crack in the foundation of the world's financial house. So what does this downgrade actually mean? Let's be clear about what an asterisk doesn't mean. It doesn't mean the United States is about to default on its debt tomorrow. Nobody seriously thinks the U.S. Treasury is going to miss its next interest payment. The U.S. can, after all, print its own currency to pay its bills, a luxury most other countries don't have. Instead, the downgrade is a warning shot. It's an alarm bell ringing, telling the world that America's long-term financial trajectory is starting to look dangerously unsustainable. Fitch was very specific about its reasons. It wasn't just about the numbers, it was about the process. They pointed to a steady deterioration in governance over the last 2 decades. Think about the repeated down-to-the-wire fights in Congress over the debt ceiling. These political standoffs, where the full faith and credit of the United States are used as a bargaining chip, have eroded confidence. It shows a political system that is increasingly polarized and unable to come to grips with its fiscal responsibilities. This isn't a Democratic or Republican problem. It's an American governance problem that has been building for years. The other major factor is, of course, the debt itself. The numbers are staggering and almost incomprehensible. The U.S. national debt is now over $34 trillion. To put that in perspective, that's more than the economies of China, Japan, Germany, and the UK combined. And it's not just the total amount, it's the speed at which it's growing. The government is expected to run a deficit spending more than it takes in up nearly $2 trillion this year alone. It's like charging $2 trillion to a national credit card that's already maxed out. This brings us to the real earthquake. The downgrade acts as a trigger, forcing everyone to look at the numbers they've been ignoring for years. For a long time, the U.S. could borrow incredible amounts of money at very low interest rates. Why? Because everyone believed U.S. debt was risk-free. But now, that perception is changing. As the perceived risk goes up, even slightly, investors will start demanding higher interest rates to compensate them for that risk. And this is where the death spiral begins. Higher interest rates on 34 trillion Australian dollars debt pile are catastrophic. Even a small increase means the government has to spend tens, then hundreds of billions more each year just on interest payments. In fact, the US is projected to spend more on interest payments this year than on its entire national defense budget. That's money that can't be used for roads, schools, healthcare, or scientific research. It's money that simply services past borrowing. As interest costs rise, the deficit gets bigger. To cover that bigger deficit, the government has to borrow even more money, which in turn pushes interest rates higher still. You can see how this quickly becomes an uncontrollable feedback loop. This isn't just a problem for the government in Washington, D.C. It affects you directly. When the government has to pay more to borrow, it sets the baseline for all other borrowing costs in the economy. The interest rate on U.S. Treasury bonds is the risk-free rate that influences everything else. So, when that goes up, so does the rate on your mortgage. The interest on your car loan gets more expensive. The rate on your credit card debt shoots up. Suddenly, the cost of living, the cost of buying a home, the cost of starting a business, everything becomes more expensive. Your purchasing power gets eroded. Furthermore, who is buying all of this new debt? For decades, foreign countries like China and Japan were huge buyers of U.S. Treasuries. It was a symbiotic relationship. They sold us goods, and with the dollars they earned, they bought our debt, which helped keep our interest rates low. But that trend is reversing. Geopolitical tensions and a desire to de-dollarize are leading many countries to reduce their holdings of U.S. debt. This means the U.S. has fewer willing lenders, just as its borrowing needs are exploding. So if foreign countries aren't buying as much, who is? Increasingly, the buyer of last resort is the Federal Reserve itself. This process, known as quantitative easing or money printing, involves the central bank creating new money out of thin air to buy government bonds. While it can provide a temporary fix, it's a dangerous game. Pumping that much new money into the system devalues the existing currency. It's the hidden tax of inflation. It means the dollars in your bank account and your paycheck buy less and less each year. The collapse doesn't have to be a sudden Mad Max-style event. It can be a slow, grinding erosion of wealth and living standards through persistent inflation. The downgrade from Fitch is the official recognition of this unsustainable path. It's a signal that the credibility of the U.S. government to manage its finances is cracking. The world is waking up to the fact that the U.S. is on a trajectory of ever-increasing debt, fueled by political dysfunction and a reliance on money printing. This is the financial earthquake. It's a fundamental repricing of risk for the asset that was once considered the safest in the world. The aftershocks will be felt everywhere. It could lead to a weaker dollar, meaning imports become more expensive, further fueling inflation. It could lead to a stock market crash, as higher interest rates make safer government bonds more attractive compared to risky stocks. It could cripple the housing market, as mortgage rates climb to levels not seen in decades. It forces a painful reality check. The era of cheap money and endless government spending is over. The consequences are now coming due. The collapse has started, not with a bang, but with a downgrade and the slow, inexorable math of compounding debt. What we're witnessing is more than just a headline. It's a critical moment of truth for the U.S. economy and, by extension, the global financial system. The decisions made or not made in the coming months and years will determine whether this financial earthquake leads to a complete structural collapse, or if we can somehow find a way to reinforce the foundations before it is too late. But one thing is clear: the warning bell has been rung, and ignoring it is no longer an option. Now, I know this is a lot to take in, and it's a deeply concerning picture. But understanding the mechanics of what's happening is the first step. If you found this explanation helpful and want to continue to learn about the forces shaping our economy and your financial future, make sure to subscribe to the channel and hit that notification bell. We're dedicated to breaking down these complex topics so you can stay informed and prepared. Thanks for watching.